Welcome to Financial Issues, where we join reality with truth, helping you make the most of your money by honoring God with your investments. Now listen in as we give you the practical tools and advice you need to become a biblically responsible investor.
Good morning. Welcome to Financial Issues. Today's Friday. It's Rapid Fire Friday. So our phone lines are already open this morning, and we've already got somebody waiting in the call queue. So Financial Issues is a ministry that helps you focus on looking at financial issues through the biblical lens. So our twofold mission is to defund darkness, giving you a way to invest in a biblically responsible way where you screen out companies who are using shareholder dollars that you've been trusted to manage to promote and advocate for and profit from nefarious activities, like things that go against our Christian beliefs. And we encourage you to be a joyful, generous giver. We call that funding the light. So all of this in efforts to encourage and educate the church about how to be good stewards. On today's show, of course, we have the phone lines open and we'll get to your questions. If you want to be the next caller in the queue, 610-363-1110 is the number that you dial. That is if you're listening to the live show, which is happening 8 to 9 a.m. Central Time. We'll also get to the latest economic information and market information, getting you in the know, and we'll get encouragement from the scriptures today. Our stewardship verse of the day comes from, Seth, what is it?
That's John 12:13.
12:13. Okay.
Good. As we're getting ready for Holy Week, a great way to tee up Holy Week. So I'm excited for that.
Absolutely.
Yeah.
Me too.
Yep.
All right, so at Financial Issues, we help you stay in the know about the financial issues of the day. We help keep you abreast of what's happening in the economy and the markets and help you understand how that impacts your own financial issues. So today is April the 11th, 2025, and my biggest takeaways from the week are as follows. Earnings season kicked off this morning with several major banks reporting. JP Morgan, Wells Fargo, and Citigroup all reported their Q1 earnings. The results were solid, but the focus was on forward guidance. So these banks said that they are setting aside more money for potential loan losses, which could be a sign that they are preparing for some economic weakness later this year. And several of the CEOs have indicated that as well. Most of them say that they're glad that Trump is taking a look at the trade situation that the United States has, the problems that we've had with trade for so many decades. But they are hoping for quick resolution, as are all of the rest of us, because if you've been watching the markets this week, you've probably needed a little bit of Dramamine.
Yeah.
The stock market did experience some extreme volatility this week. On Wednesday, the S&P surged by 9.5%. The NASDAQ was up one day over 12%, and the Dow was up nearly 3,000 points following Trump's announcement of his 90-day pause on tariffs for most countries, everyone except China. However, the optimism was short-lived. On Thursday, April the 10th, the Dow plummeted by over 1,000 points. The S&P fell by 3.5%, and the NASDAQ dropped by 4.3% over concerns that escalating tariffs on Chinese import were going to the trade war was going to keep going. So since the start of the week, I'll bring you up to speed as to where we are. The Dow is actually up 2.5%. Now, it's off 12% from its yearly high that happened in early December. The S&P this week up 3%, but still 14% off of its mid-January high. And the NASDAQ this week up 4.16%, but still down 18% from its mid-February high. The pre-markets, I don't know, I have to look. I couldn't write anything early because they kind of been all over the place, sort of hanging around the flat line. So the Dow is indicating a slightly positive open, as well as the S&P, and then the NASDAQ just turned slightly positive. So I was hoping that the markets actually learned something this past couple of weeks about trying to get ahead of President Trump or read between the lines, but they did not, because the markets sold off sharply based on what they thought was going to happen, and then they rushed back in, and then they sold off again. So I will say this, though, there is quite a bit of money that can be made off of volatility in the markets, and you not only have people trading these days, you have computers trading these days. So once the volatility starts, once it gets kicked off one way or the other, algorithms kick in, and that tends to push things, either perpetuate the positive or accentuate the negative. They also didn't learn from taking Trump at his word. On the morning that Trump announced the 90-day respite for tariffs, he said publicly that it was time to buy. So where are we on the latest tariff turmoil? Well, the White House confirmed yesterday that tariffs on Chinese goods now total 145%. On Wednesday, President Trump increased the tariffs to 125, and now they're up to 145. I'm sorry. Ours are up to 145. The White House says that this is in addition to the pre-existing 20% fentanyl-related tariff from earlier this year. Now, the Chinese Ministry of Commerce responded to the tariff increase, posting on X that if the U.S. is bent on waging a trade war, China will fight to the end. Interesting that came from him and not from President Xi. Pressure, threats, and blackmail are not the right way to deal with China, they went on to say. So, what does it seem to me? It seems to me that Trump has found China's inflection point, 145%. So, does that mean that China has been raking us over the coals for more than 145%? Perhaps China is also shifting gears and pulling out a different weapon, because they are calling this a joke now, saying that it doesn't really matter how high it goes. So, are they dumping treasuries? Are they dumping mortgage-backed securities? And if they do, what does that mean? Well, if they're dumping those things, just like they dumped their cheaply made goods into our economy, it reduced prices. If they're dumping treasuries and mortgage-backed securities, it means that demand for treasuries goes down, prices go down, and that means yields go up. So how does that hurt the U.S.? Well, I talked about it in the conference call yesterday. As soon as it's posted, if you're a partner, you can go check that out. We got CPI data this week, and that sort of flew under the radar. Usually it takes front and center as we're on the edge of our seat waiting to see what the latest inflation numbers are. Hardly anybody talked about it, because all that's being talked about is the tariffs. So I'll tell you what happened. The CPI report for March of 2025 showed a notable cooling in inflation. The headline CPI rose 2.4% year over year, down from where it was 2.8% in February. And it marked the first monthly decline, down 0.1% since May of 2020. Core CPI excludes food and energy, of course. It increased 2.8% annually. That's the yearly reading. That's the lowest since March of 2021, and it had a 0.1% month-over-month increase, which was below expectations of 0.3%. The key drivers included a 6.3% drop in gasoline prices, leading to the 2.4% decline in the energy index, which offset the very slight rise in food prices. Shelter cost, a major component, continued to increase, with an annual increase at their lowest level since November of 2021. However, the report likely captured minimal impact from recent tariffs, since they were just introduced mid-month. So we may still see inflation move higher short term to reflect that one-time price increase. But as of April 11th, 2025, Trueflation, which is a source that more accurately represents real-time inflation, reported an inflation rate of 1.34%. year over year. So this figure is derived from real-time data, not the data that CPI looks at. CPI is looking back at March. We're already into April now. So Trueflation uses real-time data from over 30 million items and 80-plus sources offering daily updates. So market reactions were mixed. Stocks dipped and treasuries fell slightly. So the Federal Reserve is going to meet again in May. They're expected to hold the rates steady, at least at this meeting, but we're expecting more cuts to come. With inflation coming into check, this could potentially free up the Fed for easing should GDP decline or the unemployment rate rise. Looking ahead to next week, all eyes will be on retail sales for March. We'll also get fresh data on housing starts, plus earnings season kicks into high gear. Now that you're in the know about the recent and upcoming financial issues, we hope you'll find out more about our ministry and how we can help you integrate those issues into your stewardship. Find us at financialissues.org. Stay tuned. We'll be right back with more financial issues.
Navigating through investment options can be challenging, especially when you're determined to uphold your God-given values. Every dollar you invest is a vote for the world that you want to live in. Let your values guide your investment decisions and help to shape the culture in which we live. Become a beacon of light and pave the way with biblically responsible investing. Timothy Plan, where faith and finance collide. Before investing, carefully consider the fund's investment objectives, risks, charges, and expenses of the investment company. This and other important information can be found in the fund's prospectus. To obtain a copy, visit timothyplan.com or call 800-846-7526. Read each prospectus carefully before investing. Investing involves risk, including the potential loss of principal.
My name is Reagan Gardner, and I am in the 4th grade. Last year, I wanted to be like everybody else. I thought I had to act different, look different, and be different to be cool. When I joined Crossroads, I learned that God loves me just the way that I am.
Help reach more kids like Reagan with the hope of the gospel. To learn more about Crossroads Kids Club and how you can get involved, visit reachOurschools.com.
Through the ministry of Preborn, the Financial Issues family has saved tens of thousands of lives of babies. What an amazing job that God has done through you, the Financial Issues family. Would you join us in saving the lives of babies? What an amazing reunion we will have in glory, meeting all the people that we have saved. Please go to preborn.org, that is preborn.org, or financialissues.org, and click on the Preborn banner.
Securities offered through G.A. Reppel & Company, a registered broker-dealer and investment advisor, member FINRA and SIPC. Opinions expressed by Shana are hers alone and are for informational purposes only and do not necessarily represent those of G.A. Reppel or the outlet on which you are listening. You should consider how the information applies to your situation prior to personally implementing it and consult any financial professional you work with to make sure it's applicable to your financial plan.
Welcome back to Financial Issues. Thanks for sticking with us today. It is Rapid Fire Friday. We've got a couple of calls in the queue. If you want to get queued up, it's 610-363-1110. So we will be live for the whole hour today. We've got room for you in the queue. 610-363-1110. Well, let's get right to it. Let's go to Joel. Joel's calling from Texas. Hi, Joel.
Hey, Shana, hang on just a second. I'm having some trouble with my phone software here. Guys in the control room, I don't know if maybe you guys can get Joel on the line. Shana, while we're waiting for Joel, you want to jump to one of these Ask Shana questions? We can see if we can get Joel back in. Oh, we got him. Good.
Joel.
Okay, there he is.
Hey, Joel.
Hello. Can you hear me?
I can hear you. Go ahead with your question.
Oh, all right. Okay. I have got about 25% of my portfolio is spread over MF 59, ETF 2, ETF 3, ETF 5, and ETF 6. And I've had those since 22, and none of them have done any good at all. I went through yesterday and added up all the dividends and looked at the increase in values on all of them, and it's less than 2% per year over that time. So I'm thinking I'm in growth and income, and thinking about retiring in the next 5 years. So I'm thinking I need to sell a lot of that stuff and put it in something else.
So are you following the fund strategy or the investment strategy where you're building your own portfolio?
Investment.
Okay. So the thing that I would encourage you to do is to use your portfolio tracking tool as the guide to where you should go. It sounds like you've done that because you know what percentage is there. And so with the investment model, our goal is to really help you build your own portfolio rather than using all funds or ETFs. So you'll notice that there are some funds and ETFs that are still in that model, primarily in the fixed income area and in the international area, because it's harder to screen for BRI in those two areas. And so those are two places that are really a good fit for those funds and ETFs. What I would suggest, if you're overweighted in that area, you're going to be moving to different sectors, you need to free up some money. First, look to see if you can do any kind of exchanges. So maybe look at your fixed income, see if anything that's in those can go to something else. Anything that's in the funds and ETFs that you need to get out of can go to another one, so that you can minimize your trading costs there if you have the A shares. And then, it's always the best idea just to follow the tracker. That's going to show you exactly where you need to go.
Right. And your exchanges, how does that work? I'm not familiar with that.
Exchanges are for mutual funds only. So I don't know. Do you have A shares or I shares?
Don't have any idea.
Okay, so you'll need to go and look. If you have A shares, that means that you paid a sales charge to go into the mutual fund up front. It's really only important if you have A or C shares to do the exchange. With the I shares, there's typically no commission to get in or out of the funds, but it just has to do with the cost structure of the funds. So for example, let's say that you're really overweighted in the Israel fund, and you're underweighted in one of the fixed income funds. Instead of processing a sell and then a buy, you process it on your brokerage platform as an exchange. And that it has to be within the same fund family, same share class.
Okay. Well, what's your advice? Because all of those, like I said, they've done less than 2%. So, is there some reason to stay in these at all?
Sometimes people stay in the funds and the ETFs if they want a less hands-on approach. So because the ETFs and the mutual funds are going to have a lot of holdings within them. What we're doing with the investment model is we're building our own. We're picking our own. Right. So you could potentially have some overlap there based on what the professional fund managers are picking versus what you're choosing in your own portfolio. So it's up to you. If you want a less hands-on approach with that, you could stay there. You'll be overweighted in your asset allocation model, but that would be an okay choice too. Or of course, if you want to redeploy that money into the sectors that you're now underweight in, which there are some new ones added. I'm sure you probably read the alert. So to move money, if you don't have the excess cash, to move money into an area that's underweighted, it forces you to sell something else. And that's just part of the natural rebalancing process.
Yeah, well, I've got about 35% in cash, and so I've got plenty of money to put in other things. Mm-hmm. But these were just performing so poorly over the last 3 years that I'm thinking I need to just get completely out of these, unless you can think of a good reason to stay in them.
That's going to be, that's up to you. You see what our opinion is based on the asset allocation models. You see where we want the money deployed. And so that's, I don't want to give away too much of the partner strategy over the air, but it should be crystal clear to the partners,
Yeah. Well, your strategy here shows that I should be invested in all of these that I'm in, but just I'm overweighted in some of them. But
Exactly.
I was just curious as to why what kind of reasoning there is to stay invested in them when they've performed so poorly.
Yeah, I don't know that I would agree that they have performed that poorly. I mean, looking back at the track records, unless maybe you know, when you're looking at something short term, it really depends a lot on when you got in, especially if you look at the volatility in the market today. So if you're measuring short term performance versus long term performance, timing matters a lot, and nobody's really good at timing the market, because every year has a 12-week high, and a 12-month high and a 12-month low, 52-week high, 52-week low. If you're measuring from the high to the low, your viewpoint is going to be skewed to the negative, right? If you're measuring from the low to the high, then your viewpoint is going to be skewed to the positive. So that's one of the drawbacks that you have in short term. And I would say that, going back to 2022, that's still relatively a short-term time horizon.
Yeah, and when I was looking at those less than 2% numbers, I didn't use today's value. I used when they were higher in March.
I see.
To figure it out,
Yeah, there's been a lot of volatility happening.
Boy,
yeah.
Right.
So it'd be a lot worse if I'd calculated it based on today. Okay.
All right. Thanks for your question, Joel. That was helpful.
Thanks, Joel.
All right. Let's shift gears to the stewardship verse today to make sure that we get it in. If we have time, we'll get to some more questions before the end of the segment. But of course, we'll come back to these questions after we take a break at the end of the segment. Our stewardship verse today comes from John 12:13. They took palm branches and went out to meet him. They kept shouting, "Hosanna! Blessed is he who comes in the name of the Lord, the King of Israel." Well, this is a key scripture going into the weekend because, of course, we're going to celebrate Palm Sunday this Sunday. So the people in the day of Jesus, when they were welcoming him into Jerusalem, they gave what they had. They had palm branches, they had their voices, and they had their praise. And they used all of that to honor Jesus as King. That's the heart of good stewardship. Joyfully giving back to the one who gave everything. And little did they know exactly what he was going to be giving and what it would cost. So as we enter Holy Week, let's reflect on how we're laying down our own branches, our time, our talents, our treasure, and we're laying them down in worship and obedience. Stewardship is more than just finances. It's a lifestyle of surrender to the King who came to save. The circumstances of how Jesus saved his people did not play out as those who welcomed him into Jerusalem with shouts of praise and welcoming palm branches. When the way that Jesus came to save didn't meet their expectations of a victorious warrior, their shouts of Hosanna turned into crucify him. So let's be like they were in the days where they were welcoming Jesus into Jerusalem. And let's use our time, our talent, and our treasure, whatever we have, to praise Jesus. Seth, did you have some thoughts?
Yeah, it's really sobering, Shana. This is a great verse, and it is appropriate as we're starting Holy Week. In Bible study this morning, we looked at the kind of conclusion of the story of the fiery furnace. And King Nebuchadnezzar, I think, is in many ways an archetype of all of us, with how he is hot and cold. 1 minute he's praising the Lord, the next minute he's trying to kill the faithful Hebrews, and then he's
literally
praising the Lord. Yeah, literally hot, especially in this story. But it really is reflective of the people in Jerusalem on Palm Sunday. You're exactly right. I mean, they were praising Jesus one day, and then 4 days later, now they're trying to kill him. And it's just such a reminder for us that we have got to guard our hearts and make sure that our hearts are always loving what is most important, and that's Jesus Christ. And we have such fickle hearts, Shana. And even as I'm thinking about what's happening this week, like you said, with the markets, it's been a wild week. We can so easily let our hearts be swayed by whatever the news is telling us, but they need to be chained to the scriptures. So hopefully that can be of encouragement for sure.
Yeah. when times get turbulent like this, when there's a lot of news going on, and I even find myself glued to the screen sometimes, or reading different things and trying to discern what's going on. But the Holy Spirit constantly reminds me, Shana, if you're spending more time on all of these other things than you are in my word, in prayer, in the scriptures, then you're off kilter. Yeah. You're off kilter, right, and your anxiety is going to be going up. If you're in the Word, you're peaceful, right? You're reading the Word, you're hearing the promises. Yeah. You even read about the hard things, but it's the peace of Jesus that really comes through. The world will get our anxiety up. Will cause us to. All kind of things to happen. They'll cause us to act in fear. They'll cause us to panic. It'll even have physical effects on our bodies. But we just need to stay focused on what's most important.
Amen.
Well, folks, if you're listening on a station that only carries the 30-minute version of the show, we wish you a farewell, but we are going to continue on live here with Rapid Fire Friday if you're watching the full live show. If you have to go, you can always catch the full show on podcast, Apple or Spotify, or on our phone app where you can get all the past episodes. Find out more about our ministry. Go to financialissues.org. Everybody else, stay tuned. We'll be back.
Where's Mima? We found out Shepard's diagnosis when I was about 17 weeks pregnant. We learned that he was going to need a series of surgeries after he was born in order to give him what they considered a normal life. And we weren't sure how this worked.
Yeah, very emotional, very, very broken. And as my wife just said, not sure how this worked. And called Samaritan, and they said, you just go have that baby. You leave the rest to us.
And just to hear the confidence on the other end of the phone of this is not something that you need to be concerned about at all. You focus on the health of your family, the health of your baby, and we will walk with you every step of the way.
I found out I was pregnant when I was 21 years old. For me, I was scared, I was shaking. I Googled places to abort. We drive there, and as soon as we get there, I open the door, and the first thing that I see is a bunch of Bible verses in the walls. They gave me a little counseling session, they gave me the pregnancy test again, and they do an ultrasound. And that's when everything changed. When I saw my baby, and when I heard her heartbeat, that was it. We decided with my boyfriend at the time, which is now my husband, to continue the pregnancy together. We started coming to the classes, doing our homework, getting counseling together. We've seen the hand of God ever since we stepped into the pregnancy center.
To find out how you can support the life-saving mission of Preborn, go to preborn.com/FISM.
Every day, kids all across America are coming to school with some kind of hidden pain.
I've seen kids come in who are just so confused about what's right and what's wrong, just having no idea that God loves them. And this just breaks my heart. Crossroads has the opportunity to bring the Word of God right into the public school, to reach children right where they are.
And when we see that happen, we see God changing lives.
We want to see kids not only come to Christ, but pursue a lifelong relationship with Him. And so local churches are uniquely positioned to disciple those children as they become young adults and through their lifespan.
Crossroads comes alongside a church and provides that church with a club structure, curriculum, training, and ongoing coaching for them to run these outreaches in public schools.
If you are burdened for the children of America, consider making a donation to Crossroads Kids Club. For more information, visit reachOurSchools.com. That's reachOurSchools.com.
Welcome back to Financial Issues. We're going to continue on with Rapid Fire Friday. The number, if you want to get in the call queue, 610 610-363-1110. We have one person that we're about to get to, and then the line will be freed up. So 610-363-1110. You can actually call now and just get in line. All right, let's go to Bob. Bob's calling from Ohio. Hi, Bob. You're live.
Hello. Happy Friday to you.
Happy Friday.
So thankful and blessed with the new website. It's a beautiful thing, and I know we're still working some of the kinks out in it little by little, but it's amazing. Thank you so much for all the hard work.
Absolutely.
Awesome, Bob.
So I'm 54, okay, and I picked the growth model for the fact that I started late and I'm behind, and I'm trying to somewhat catch up. Is that a good idea, or is that not a good idea?
Well, let me ask you this. If you started late, does that mean that you're going to work longer?
I believe I'm going to have to, sure. Yes.
So how many years do you think you have where you'll be saving, putting money away before you get to the point where you're retired and drawing down on the portfolio?
I can't tell for sure, but I would say at least 11 or 12.
11 or 12 years?
Yes.
And how would you describe your risk appetite? If you woke up tomorrow and your portfolio was down 50%, what would you do?
Yeah, I'm not afraid, because I do believe, like you said, and I've seen the track record to where it does come back, and it just as long as I don't panic. I'm not much for panicking. I can understand. I can deal with it if it goes down like it did recently, and it was pretty dramatic. But I knew it's coming back up. It's not that long, so I can handle that.
Yeah. So a lot of times when people tell me that they started late, so they feel like they have to be more aggressive, I would agree, but it doesn't necessarily mean that you have to be aggressive just in your investment portfolio. So if you still want to retire on time, I guess the standard is age 65, then you have to be really aggressive in how much you're saving. So to catch up, maybe you can't totally catch up, most likely, by just being more aggressive. You'll probably have to be aggressive in looking at your current budget, allocating more money towards your investment portfolio than you do towards living expenses. Or perhaps you're going to have to be aggressive in as you make up your budget for post-retirement. So it's going to be a combination of all of those, very likely. What I would say is one of the new things that we added to the website, there are some more robust descriptions of each of the models as we've tried to simplify this. So if you go to the asset allocation page, I believe it's an orange button, and it says something like full descriptions. If you'll go through there and you'll take your time and read the description for the growth model, read the description for the growth and income model, it's going to give you lots of things to think about. And I think by the time that you're done reading both of those and give them some thought, you're going to know exactly where you should be. So just keep in mind that the growth portfolio is going to be 100% equities. So it can be subject to some really high volatility. Typically, you want at least 15 to 20 years to be in the growth portfolio, 15 to 20 years where you're going to be aggressively saving, adding to the portfolio, because in your accumulation years where you're accumulating money in your investments and your savings, market volatility is your friend, because when the market goes down, you're getting more shares at a cheaper price. The closer that you get to retirement and to needing to draw down on that money, the focus shifts. Volatility is no longer your friend. In fact, it works exactly opposite when you're taking money out as it did when you were putting money in. So downside market volatility will hurt a portfolio that's in the distribution phase much, much worse than just a static portfolio. So you have to make sure that you give yourself that time to transition.
Okay, great. Thank you. That is totally helpful. I have one more real quick question. It will be fast. So in the growth model now, my materials, are overweighted by 11%, and there's a new sector in there called what is that called?
Commodities.
Commodities, yeah. And the only thing I saw in the commodities were two of them two of the ETFs that used to be in the materials. So I'm not sure what I should do there.
Have you gone through your material sector on your portfolio tracker? Do you have any that fit into that commodity sector? Have you recoded them?
I do not. I have not, and I don't know which ones would be able to get converted to the commodities, because I don't have either one of those two ETFs. Okay. That's all that shows in the commodities.
Okay, so what I'll say to that, whenever we added those two new commodities, we put out a note, we sent out several sell alerts for the materials sector, and as we did that, we said, this is going to free up money to go into these new holdings, which were then part of the materials sector. Now we've just separated them out so that you have more clarity. You can see exactly how we suggest that the materials is split up. So it's not that big of a deal if you want to stay in those material stocks. But what you want to look at, and now you have this nifty feature on there that tells you what industry they're in. So if most of your material stock are in the metals and the mining part of that sector, then you're probably okay.
Okay. All right. Is there anything in there that tells me in any of those materials that I could code those possibly as
not really. Just what I basically just said. Anything that's metals or can kind of go in that sector. Any company whose price is very heavily driven by those underlying commodities.
Okay.
And the description in the industry.
Okay, the commodities of metals and commodities of metals and what else? Mining.
Metals and mining. Those two.
Okay, great. All right. Thank you so much. You have a great weekend.
Thanks, Bob. You too.
Thanks, Bob.
All right. Bye.
All right. I heard the ag's coming soon.
We might be able to squeeze in a question here, Shana. Okay. There's a quick one here from Jason. I believe he's asking about Citibank, CIT. He's wondering, is this a good option for a high-yield savings? He's 40 years old.
Okay, so there's a lot of options for high-yield savings out there, and, I don't follow all of them. What I would suggest is that in your savings, your savings is primarily, in my opinion, for a couple of reasons. It's for in case you have emergencies so that you don't have to sell longer-term investments, and it's also for stability. If you have, cash in your portfolio, it's primarily as a cushion for market stability. So yes, you want to get a good yield on your savings, but I think convenience in this case is more important, because although you may find outliers here and there offering introductory rates, if you're always chasing that, you're going to consume more of your time than it's worth trying to move money from place to place. So what I like to do is just look at what the options are for the places that I'm already doing business. So if that's the credit union, if that's my brokerage account, I look for the highest yielding option there. Well, folks, we've got the Ag Report coming up. After we hear from Craig, we're going to take a short break, and we'll be back with more Rapid Fire Friday. So if you want to get your call queued up, you'll be the first caller in the queue. The number is 610-363-1110.
This is Craig Haugaard with your Financial Issues Ag Update for April 11th. Well, the USDA's supply and demand report caught corn traders by surprise yesterday as they reduced the projected ending stocks by 75 million bushel. Traders had been expecting a reduction, but they thought it would be more in the 25 million bushel arena. The USDA got to that number by increasing exports by 100 million bushels while cutting feed usage by 25 million. At the closing bell, May corn was 9 cents higher at $4.83 per bushel. Soybeans had their carryout declined by 5 million bushels, which was greater than the average trade guess, which was looking for just a million bushel decline. Imports were increased by 5 million bushels, while domestic crush grew by 10 million. At the close, we had May beans with a very strong reaction. They were actually 16.25 cents higher at $10.29. For wheat, the April supply and demand report gave traders a picture that includes larger supplies, slightly smaller domestic use, reduced exports, and increased ending stocks. Now, Obviously, none of that is bullish. As a result, we saw the wheat market set back. Minneapolis May wheat was 6 3/4 cents lower at $6.02. Kansas City dropped by a dime to close at $5.58. And we had Chicago 4 1/4 cents lower at $5.38 per bushel. Cotton futures saw a muted reaction to the supply and demand report, which saw the U.S. cotton carryout numbers swell up to 5 million bales by cutting exports by 100,000 bales. May futures ended the day 16 points lower at 66.47. Livestock futures were mixed. We had June live cattle $3, 17.5 cents lower at $195.20 per hundredweight. May feeder cattle dropped by $2.90, settling at $275.30 per hundred, while our June lean hog futures were $1.47.5 higher at $93.17.5 per hundredweight. Class 3 milk futures continue to work higher. At the closing bell, we were up 6 cents at $17.45. This has been Craig Haugaard with your Financial Issues Ag Update. We'll be right back with more financial issues after this.
It's up to us to stand up and say, enough is enough. All of this unbiblical stuff that's going on, whether it's abortion or transsexual or LGBTQ, widespread pornography, human trafficking. Bottom line, it's still up to us. If we stop investing in these corporations that are trying to destroy us, sooner or later they're going to wake up.
To learn more about biblically responsible mutual funds and ETFs, go to timothyplan.com.
If a woman sees her baby on ultrasound, it doubles the likelihood that she'll choose life. On top of that, we share the gospel of Jesus Christ with her. This is why you should support preborn.
Then they sat me down. If you were to die today, do you think you would go to heaven? And I was like, no. Keeping the child was my first stepping stone. And ever since then, God has cleaned me up from the inside out.
Help support women in need. Go to preborn.com/FISM.
What separates Crossroads Kids Club from other ministries to reach school-age children? What sets you guys apart?
First of all is our connection with local churches. We mobilize, equip, train, support local church partners. We're right inside the schools. There's a number of ministries that try to serve public school children outside of the school, but we're able to be right there on the campus. Another key thing is just our values. Our highest value is actually relationships. And so we're not a ministry that's driven by a lot of fancy technology or flashy stuff, but rather getting adults who love Jesus and who love kids to sit on the floor with a group of kids, to listen to them, to love them. So I would say the relational emphasis and the simplicity of the model is actually something that makes Crossroads special as well.
Help reach kids with the hope of the gospel. Visit reachOurschools.com.
The opinions and recommendations expressed on this program do not necessarily represent the opinions of the station or any of the program sponsors. Additionally, all products or services offered by the program sponsors may not be known by the program.
Welcome back to Financial Issues. Thanks for sticking with us here. It is Rapid Fire Friday. Our phone lines are wide open, 610-363-1110. If you can get your fingers to dial that number quickly, I'd say in the next 60 seconds or so, we'll be sure to get you into the show today. So we spent a lot of time today talking about the markets, the economy. We've talked about our strategy. We've answered questions about all of that. But, we talked about in the stewardship verse of the day how we don't want to neglect the Word of God and the things that God is asking us to do. So, yes, He wants us to be good stewards. He wants us to be biblically responsible, I think. It's always good for us to honor God in the way that we do everything, and the way that we honor Him and the way that we invest is to do biblically responsible investing. But the second part of that is to fund the light. So we just want to encourage you as you're going through Holy Week, as you're starting to feel so grateful for the great gift of Jesus Christ, what He did for us and how He saved us, and how we can honor God course, we can do biblically responsible investing. We can also use resources to give. So a great ministry that you can give to is the Ministry of Preborn. They have been a partner of ours for a very long time, and Preborn is instrumental in pushing back the darkness and fighting the good fight in the space of abortion. So Preborn has clinics where they give free ultrasounds to women who are in crisis pregnancy, because they have found that when a woman sees her baby on an ultrasound and hears the heartbeat of her baby, she is way more likely to choose life. So every effort that you give every dollar that you give to Preborn goes towards their twofold effort. That is helping mothers choose life for their babies and to choose life for themselves. Because when they go in for that ultrasound, not only will they see the information and get the information about the life growing inside of them, but they will also get the life-saving information that comes from hearing the gospel of Jesus Christ. So you can find out more information about Preborn by going to our website, financialissues.org. All right, let's continue on with some of the Rapid Fire Friday questions.
Yeah, sounds good here, Shana. Love that, the Preborn comments, too. They're doing some great work. We've got Marcia here. Marcia's 73. Marcia is actually from our home state of Pennsylvania. I've had the privilege of meeting Marcia and her husband, Dan, here in the Philadelphia area, so it's good to see her here on Ask Shana. But she's saying, regarding preferreds, I understand how a bond works. You bring it to the bank when it matures, date given on the bond, and then receive cash when it has matured. How does a preferred work? Does it mature like a bond and you have to cash it in? If so, do you know the maturity date? Do you sell it when it matures in a brokerage account? I think she's just looking for some more guidance here, Shana.
Yeah, so preferreds work in a very similar way. I would say that even bonds, in the age of automation, I don't even know how many people still own physical bonds or physical securities at all. I think most people just own them in their brokerage account. So even when the way that a bond works, a bond is a debt instrument. So when you purchase a bond, whether it's from the government, a municipality, or a corporation, you're basically loaning them your money for a time period, and you do know what the maturity date is. So either 1 year, 5 years, 10 years, 30 years, even there's some that are longer than that. So you know that you're going to, or you have a good belief that you will get your money back at some point in the future on that maturity date. In the meantime, you're going to receive a cash flow. You're going to receive regular interest payments on your money at whatever interval is stated, whether it's monthly, quarterly. Usually for bonds, it's semi-annually. Preferreds work very similarly. Preferreds are technically considered to be equities. They are issued mostly by corporations when they want to borrow money. It's a way of borrowing money. Normally, a preferred is issued at $25 a share. A lot of times, in the past, there was a stated maturity date, but most preferreds these days are perpetual, meaning they might have a stated maturity date, but they can extend past that. So there is a pretty healthy secondary market. So if you ever want to get out of your preferred, you can sell it to someone else who is willing to buy it on the secondary market. But most preferreds these days are perpetual. Now, lots of them do have call dates, so they can call in or they can refund the value at par, usually $25 on a certain date. But what you'll notice if you go look up the call dates and maturity dates of those, that most of them are past due. So the reason that a preferred stock issuer would call that back in is if they were able to refund, either they had just a ton of money and they wanted to get rid of some of their debt, they might call in the preferred and just pay it off and get rid of debt. Or if interest rates go really low and they're significantly lower than the rate that they're paying you, then they might want to refinance that debt. Much like if you had a mortgage at an 8% rate and interest rates went down to 4%, you would want to refinance your mortgage. So that's how they work in a nutshell.
It's awesome, Shana. Very good stuff. Next one is Mark, also 73 years old. Mark's got a great question here. This is cool. He says, my granddaughter made about $1,200 last summer. Can I set up a custodial Roth IRA for her? And is this a good idea? If so, how might I go about it? What do you think?
Yeah, so I think it's an excellent idea, and you typically can do that. You can set up a custodial Roth account for your granddaughter. I think the best place to do that would be at a discount brokerage place, maybe wherever you do business. You can set that up. I'm assuming that you're going to want to fund that for her. So you do have to have earned income to be able to contribute to a Roth. So if she does have that $1,200 in earned income, that would be the max that you could put in for her. So the limit is $7,000 if you're under 50 years old, but it's limited to 100% of your earned income. So the other questions that I would have you consider is, does she have a good way to prove that she's got the $1,200 in earnings? If that's all she made, it's very likely that she doesn't even have to file a tax return. So there's no proof that she has that earned income, but she could keep, maybe if she made it from babysitting or, cutting grass or cleaning or something like that, she has some proof, maybe some receipts, some invoices, and they can just be really simple handwritten things that she can keep on file to prove that she did indeed have that income. So I like the way you're thinking, Mark. That's a great thing. And I don't know how old she is, but as soon as you can teach her and you can show her how investments work, how these things, how money can grow for her, that's going to be a really great thing to do. Now, keep in mind, if it's a custodial account, she will be able to have full access and make decisions over that money as soon as she becomes the age of majority in your state, whatever that is, somewhere between the ages of 18 and 21. So you're gonna want to make sure that you impart a lot of wisdom about how she is to handle that money when it becomes under her control.
Yeah, well said. And that's really good. A great thing for Mark to do for his granddaughter is tell her to listen to the show, because there's a lot of wisdom here on the show. Pretty cool.
Absolutely. Yep. And when she's ready, you can gift her a partnership.
Yeah, that's right. That's right. That's awesome. Good stuff, Shana. So this next one comes from Hayne. He has two questions. The first one, first of all, he says he's got a small amount of money, about $100,000 after tax investment. He says, in January of 2025, I bought FP42 and it wasn't the correct QSIP for it. It's 1% of the portfolio. Should I sell this and buy the right one, or just wait until the LT cap gains and buy the other when I can? What do you think for that one?
My tendency is to want to correct it as soon as possible. Yeah. I wouldn't imagine that the gain on it would be super significant. And then, and even if it is, there's a good chance that maybe you have some positions in your account right now that are down in value. You could consider, harvesting some of the losses to offset that gain if it's really necessary. Just make sure that if you do that, if you're going to be selling a position that you would have kept and you're just doing it for tax harvesting reasons, that you wait that you haven't bought it within the last 31 days, and then you wait another 31 days before you actually buy that one back. So my suggestion is to remedy the mistake as soon as possible.
Absolutely. And then the final question of the day here, Shana, his second one. He has MF72, FX68 at a fund. Both are too high of a percentage. Do I wait to reap profit now that the market has dropped? And he also says he loves changes to the website. He's 75. What do you think?
I would just do it in a very disciplined, methodical way. Timing the market is oftentimes foolish. And so, I'll always point people back to that portfolio tracker. That's going to give you the best direction on what you need to do, and then just decide on a course in your mind. If it's a big change, you may want to do it over several months. If it's a small change, you could just go ahead and just get it done and don't look back. All right, folks, I hear the music. We're at the end of the program today. Thanks for joining us for Rapid Fire Friday. We hope that you learned something. We hope that you were encouraged. And we hope that you will be spending this Sunday gathering together with believers and worshiping the Lord on this Palm Sunday. So we hope you have an awesome day of worship on Sunday and that you come back next week for more financial issues, because we want to continue to remind you that the Master is coming back. He owns everything, and he's going to ask for an account of what we did with time, talent, and treasure when he returns or when we go to see him. We want to help you be found a good and faithful steward. Find out more about our ministry at financialissues.org and come back next week for more financial issues. I'm your host, Shana Burns.
If we ever forget that we're one nation under God, then we will be a nation gone under.
Thank you for joining us. This has been an FISM production.